Options trading. Options trading. Options trading explained basic concepts for beginners. Ever wondered what stock options are, and what the benefits of trading options are as opposed to simply trading stock? Keep reading to learn options trading basics and why people trade them. You'll learn each concept with visualizations to help you understand options logically. What is options trading? Options trading is the act of buying, selling a stock's option contracts in an attempt to profit from the stock's future price movements. Traders can use options to profit from stock price increases, bullish trades, decreases, bearish trades, or even when a stock's price remains in a specific range over time, neutral trades. The benefits of trading options instead of shares of stock are: leverage. With options, traders can leverage return potential, which means significant gains can be made with relatively small amounts of money. For example, an options trader can risk $500 and make $500 100% return on investment if their stock price prediction is correct. When buying shares of stock, the stock price must increase 100% for you to double your investment. However, there's also the potential to lose more money compared to trading shares of stock. Leverage can work for or against you, but when used carefully it can increase returns on investment immensely. Less risk than trading stock, sometimes. Another huge benefit of trading options is that the strategies used can sometimes have significantly less loss potential compared to buying, shorting shares of stock. Unlimited strategy customization. As mentioned earlier, options can be used to profit from virtually any stock price movement, or lack of, in the future. Unique option characteristics. Before getting to the specific details related to options, we need to first cover the unique characteristics of option contracts. Expiration date, strike price, contract multiplier. Expiration date. All options have expiration dates, which is the date the option's final value is determined and can no longer be traded. Stocks typically have options with expiration dates ranging from a few days to 2 years away. Strike price. An option's strike price is the price at which shares will be bought, sold if an option is exercised. We'll talk more about this in a moment. Contract multiplier. The number of shares an option contract can be converted into. Typically, equity options like AAPL options have a contract multiplier of 100. Each option can be converted into 100 shares of stock. Options and leverage trade example. Our first trade example will demonstrate how options can leverage returns compared to simply buying shares of stock. Trade example, stock trade versus option trade. Stock trade: buy 4 shares for $150, sell 30 days later for $160. Profit plus $40, 6.7% return, $40 profit, $600 investment. Option trade: buy the 30-day 150 call for $5. Sell for $10 in 30 days, stock at $160. Profit plus $500, 100% return, $500 profit, $500 investment. As we can see, the option trade resulted in a much more significant return relative to the money invested. However, if the stock price remained at $150 over the 30-day period, the stock trader would not have lost any money, while the options trader would have lost the entire $500 investment. If you're wondering, buying a $5 option costs $500 because of the option contract multiplier of 100. The $5 option price is on a per-share basis, which means the actual cost of the option is 100x more than the option's displayed price. The two option types. Call option gives buyers the right to buy 100 shares of stock per contract at the option's strike price before the option expires. Here are some examples of what this means. Strike price $100. Meaning call buyer has the right to buy 100 shares of stock for $100 per share before the option expires. Strike price $120, meaning call buyer has the right to buy 100 shares of stock for $120 per share before the option expires. Since there's more value in having the ability to buy shares of stock at lower prices, call options with lower strike prices cost more money. Additionally, call options at lower strike prices have a higher probability of being valuable at expiration, as call options only have value at expiration if the stock price is above the call strike price at the time of the expiration date. Call option example. To make sure call options make complete sense to you, let's look at a hypothetical trade example to demonstrate the profit-loss potential when buying a call option. At $50 or less, at or below the call strike price, the option will be worthless at expiration because there's no value in being able to buy shares of stock at $50 with the call option when the stock price is at or below $50. At $55, the call option is worth $5 at expiration because the ability to buy shares of stock $5 below the current share price is worth $5 per share. At $60, the call option is worth $10 at expiration because the ability to buy shares of stock $10 below the current share price is worth $10 per share. At $65, the call option is worth $15 at expiration because the ability to buy shares of stock $15 below the current share price is worth $15 per share. Compared to buying shares of stock, buying call options can have significantly less loss potential when the stock price falls substantially. However, for the call option to break even or profit, the stock price must increase. Clearly, as a call buyer you want the stock price to increase as much as possible above the strike price, as the call's ability to buy shares at a discount to the current share price will become more valuable, meaning the call option's price will increase. Just like shares of stock, call options can also be sold as an opening trade. For instance, let's say a stock is trading for $100 and we sell the 110 call for $5. When selling call options, as long as the stock price is below the call strike price at expiration, the position will be profitable. However, if the stock price rises substantially, the loss potential on a short call position is theoretically unlimited. Here's how this particular short call position would perform based on various stock prices at expiration. For instance, if the stock price rose to $200 by the call's expiration date, the loss would be $8,500 per call that was sold. With the stock at $200, the 110 call would be worth $90 because the ability to buy shares $90 below the current share price is worth $90 per share. Since the call was sold for $5, the loss would be $85 on the option, which represents an $8,500 loss per contract due to the option contract multiplier of 100. At $115, the call would be worth $5 and there would be no profits or losses. At $110 or lower, the 110 call would expire worthless and the call seller would keep the $500 collected when initially selling the call. Because of the risk outlined above, it's not advised to sell call options without protection in the form of long stock or another call option purchased against the short call. The second option type, puts. The second option type is called a put option. Put option gives buyers the right to sell 100 shares of stock per contract at the option strike price before the option expires. Here are some examples of what this means. Since there's more value in having the ability to sell shares of stock at higher prices, put options with higher strike prices cost more money. Additionally, put options at higher strike prices have a higher probability of being valuable at expiration, as put options only have value at expiration if the stock price is below the put strike price at the time of the expiration date. Like we did with calls, let's go through a hypothetical put option trade example. Trade example: stock price $200. Trader's prediction share price will fall to $190 sometime over the next 30 days. Option trade: buy the 30-day 200 put for $6.50. At $200 or higher, at or above the put strike price, the option will be worthless at expiration because there's no value in being able to sell shares of stock at $200 with the put option when the stock price is at or above $200. At $195, the put option is worth $5 at expiration because the ability to sell shares of stock $5 above the current share price is worth $5 per share. At $190, the put option is worth $10 at expiration because the ability to sell shares of stock $10 above the current share price is worth $10 per share. At $175, the put option is worth $25 at expiration because the ability to sell shares of stock $25 above the current share price is worth $25 per share. Compared to shorting shares of stock, buying put options can have significantly less loss potential when the stock price increases substantially. However, for the put option to break even or profit, the stock price must fall. Just like calls, put options can also be sold. For instance, here's how selling a put would work out if we sold a 170 put for $7 on a stock that was trading for $190. As long as the stock price is above the put's strike price at expiration, the position will realize a full profit and 100% of the option premium collected when selling the put will be kept. The reason for that is the put will be worthless because there's no value in the ability to sell shares at a price below the current share price. However, if the share price falls, selling put options can result in significant loss potential. For example, if the stock price fell to $150 by expiration, the 170 put would be worth $20 because there's a $20 per share value in being able to sell shares $20 above the current stock price. Since the put was sold for $7, an increase to $20 would represent a $1,300 loss per put contract that was sold. The worst-case scenario when selling puts is that the stock price falls to $0, the company goes out of business before the option expires. If you enjoyed this guide and want specific research and full trading plans, check out our options trading courses. Trading options has its benefits over trading shares of stock, but, as you've learned, there are also some massive risks related to trading options. Hopefully, you've learned the basics of how options work and are prepared to keep learning. If you are, check out our guides on options trading basics to take your knowledge to the next level. Thanks for watching.